Hey everyone, Happy New Year. George Almaster here. Obviously, you guys know me by now, but just wanted to share some information with you on the progress of the home. Not to show off or any of that, obviously. I'm doing it to kind of share with you the strategy. So, if you guys have maybe heard of the strategy called buy-fix-refinance, and that's kind of what I was planning on doing with mine. So I got a really rundown property. I got it for a good deal, and I've made some improvements to the home, and there's a little bit of room now to potentially refinance it. So the advantages of doing something like that is that you avoid paying, or I shouldn't say avoid, you kind of defer your capital gains tax. Because if you buy a property and sell it within a year, typically you will be charged a tax for doing that. The other part is that you'll be able to save on some of the selling costs. So there's obviously lawyer fees. You'd have to pay a real estate agent to sell your place and whatever else. So if you go with a refinance strategy, you'll be able to withdraw equity from your home and then not have to pay a lot of those fees. So I can walk you through some of the costs, including some of the renovation costs and such that I had to incur, and then where I'm at today in terms of the value, and then what I could do from here. So I'm just going to shift the camera down. I'm going to do this the old school way because I don't know how to edit videos and put everything on the screen. So hopefully you'll be able to see what I've got written down over here. Okay, so the home that I bought, as you guys may have seen from previous videos, it was purchased in Hamilton. It was a Hamilton property, and I ended up buying it for $215,000. Okay, so obviously I got a good deal. It was originally listed at $269,000. They brought the price down a couple times and ended up picking it up for that price. Now it was really beat up, so for first-time investors, I do not recommend going after a project that was as intense as this one. There were a lot of times where I was kind of pulling my hair. It was my first time I ever did anything like that, so it was difficult to do. Go after something that just needs cosmetic improvements. So the down payment, let's just say for the case of this example, we'll go with 20% down, which is what investors would need if they were to purchase an investment property. So that would be $43,000. So your mortgage balance on this would be $172,000. So this is how much you would borrow from the bank, less obviously when you include your down payment, that'll total $215,000. The closing costs on this deal, so these are just some of the basic stuff. The land transfer tax on this was $1,875. You had a home inspection of $500. Some people choose not to do it when they get a good deal on a property. If it's really run down, they know everything needs to be done. But for a first-time investor, definitely do a home inspection. The appraisal, typically that'd be about $200. The lawyer, in this case, costed about $1,500. And then title insurance is usually somewhere around $200 as well. Okay, so the total closing costs here, let me just double check. There might be some stuff that I didn't include here on my sheet, but it's included in my spreadsheet. So that would be a total of $4,000 just about. That's what mine ended up costing for closing costs. Okay. So now if we get into some of the rental costs, these are just some of the main things. There were tons of other little things, so I'm not going to include everything. But in this case, the flooring, I ended up getting laminate, which was $1 a square foot times 1,200 square feet. So that would be $1,200. And then there were baseboards. All of that ended up costing somewhere around, $600. You got in the kitchen, the main things, the appliances. I bought a fridge and stove, as well as a range hood, stainless steel. So they were used, but in good shape. So ended up paying $1,500. The backsplash costed somewhere around $250. So I installed the backsplash myself. Washer and dryer, I got it on Black Friday, so there was a deal on them. I think I got both of them installed and delivered for $850, if I remember correctly. And then the carpet install ended up costing about $650. I put carpet on the stairs rather than go with wood. It would have costed quite a bit more, somewhere around $60 to $80 a step. So $650 installed. Again, I got it from Home Depot. They had a deal where if you buy a certain amount of carpet, you get the installation for free. So for me, the total renovation costs, including the carrying costs, so let's say I had the property for 3 to 4 months, and I had to pay a mortgage on that, property taxes, all that. So altogether ended up being about $15,000 for the renovations. Now, if we look at the ARV, which is the after repair value, I would say it's worth about $375 today. All right, big difference from where we started to where we ended up. Now, the way it works with regards to refinancing, so this is the important part of the strategy. If you were to sell it today and you got $375, you'd have to pay commission, you'd have to pay lawyer fees, all sorts of closing costs, whatever else, and then capital gains, and you would end up with a significantly smaller number. But if you choose to go with what I think is a much smarter strategy, you refinance it. So what banks will do, if you qualify, obviously you have to have the income and whatever, they would give you 80% of 375 because you have to keep 20% equity in the property. So if I do it on my calculator here quickly, times 0.8, that would be 300,000. So they'll give you a new mortgage of $300,000. So what does that mean for you? You still have the original mortgage, right, of 172. When you first bought the property, this is how much you borrowed. So you have to reduce that amount from the refinance amount. And then if you want to look at what's left in your pocket after everything, you'll account for the amount you initially invested, which was your down payment of $43,000. And then you will deduct what you put into the property. Okay, so the calculation is very simple. You take your new mortgage amount, you reduce your original mortgage balance, your down payment, and your renovation costs, and then you'll see what you'll have left in your pocket, or if you're at a break even or whatever. So let me just do the numbers. Minus 172, minus 43,000, and then minus 15,000. So in this example, after pulling out all of your money from the deal, so you literally have $0 invested in this home. You get a free house. You're making $70,000. You're able to withdraw $70,000, and then you can use this money here to reinvest it in another property. So you can find another similar home, put down the $43,000, and use some of the remaining amount to renovate or whatever else. Now, obviously, with this number here, there will be some fees from your lender because you're kind of breaking your mortgage, refinancing, so it's not going to be exactly 70, but this gives you a ballpark figure. It's a strategy that works really well. People are doing it in different ways. You could do it with larger homes like triplexes, four unit homes, sixplexes, whatever. So if you have any questions about it, feel free to give me a call. I'll be happy to give you some more information, but I hope this helps. And as always, I'm never too busy for any of your referrals if you come across anyone who's thinking about investing in Hamilton, Niagara, or St. Catharines. All right, so we'll talk to you again soon. Have a great day.